Welcome to the Holo Report from Hollow Point Trading. Today we're doing a 90-page deep dive, including a snow fact check, an AI melt-up analysis, and a bear setup review. Here is a look at our table of contents for today's video. We will cover the market state, the dynamic between retail and institutional traders, earnings reactions, a deep dive into snow, and more. The key themes of the video include an S&P rally parallel to the 2000 top, the financial engineering behind Snow's 30% pop, the pattern of retail dumping and institutions buying, and the debt and dilution fueling the AI melt-up. We begin with the market state, an 8-week rally, up 19% off lows, hitting resistance across all timeframes. This chart illustrates the S&P 500's 8-week rally, showing a gain of 19.25% off the March 30th low. This setup is similar to the 2000 top's 17.5% rally. Comparing the current rally side by side with the 2000 top shows remarkable similarities. Both rallies followed a roughly 10% pullback, and both topped on inflation worries before giving back all the gains. Examining the weekly 9-count, S&P 500 and Nasdaq 100 are starting the week with bar 8 of 9. The Semiconductor ETF is already at bar 9 this week, and the previous 9-count led to a pullback. The Elliott wave 5 of 5 appears to be completing. We have rallied for 5 sessions off the minor low, and wave 5 could wrap up this week. We are seeing multi-point divergences on key indicators. The weekly channel shows the market is slamming into 2022 resistance, suggesting a critical point for the current upward trend. On a monthly scale, the S&P is testing the upper boundary of a 100-year channel or a rising wedge. Highs from 2021 and 2022 are all pointing to the current price level. Next, let's look at retail versus institutions. This section explains the, quote, food chain dynamics, where retail traders tend to sell in the first hour and institutions buy in the last hour. The first hour versus last hour theory details how retail activity drives the market initially with stop hunts and emotional selling, often resulting in the day's lows. In contrast, institutions drive the market calmly and deliberately in the last hour, often leading to the day's highs. The SanDisk upgrade serves as a textbook example of first-hour puke. The price opened higher, was quickly stop hunted down, and then institutions bought every dollar before closing significantly higher. This chart visualizes who moved the market at different times. Retail selling dominated the early hours, setting up the market for institutional buying later in the day. The food chain illustrates the tiers of traders. Tier 1 are insiders/Goldman, followed by sharp hedge funds, smart retail, mainstream institutions, and finally, late retail reacting to Twitter buzz. Consider this question. When the news hits and everyone knows, who is left to buy? Institutions are already in. Newsletters and Twitter are handing it to retail, and if your mom is asking about it, you are likely the one holding the bag. Next, we move to earnings reactions, covering Marvell, HPQ, Snowflake, CRM, and Zscaler. We'll examine which companies beat, which might have misled, and which faced market punishment. Marvell had a great quarter with inline revenue, strong guidance, and a beat on gross margin. However, the stock barely moved until the conference call, when they sold it right down. This suggests institutions were already positioned. HPQ also beat and raised expectations for revenue, gross margin, operating earnings, and guidance. Yet the after-hours move was only 30 cents, indicating a muted reaction despite the strong results. The hedge play involves owning calls and shorting stock into the pop to lock in the spread. If the stock drops, buy back the short and keep the calls. If it keeps going, calls offset the short loss, which is critical for after-hours options trading. Snowflake popped 30% after hours, with strong revenue, product revenue growth, and RPO. However, the $6 billion AWS commitment compared to $4.8 billion cash on hand raises significant questions. CRM saw a surprise pop on the call, despite lowered guidance across the board. This should have looked like Zscaler 2.0, so watch the price action closely. Zscaler dropped 21% after hours, which is the software bloodbath. They lowered revenue guidance, and EPS is rising due to cost cuts, not growth, suggesting they are managing their way to the exits. This chart summarizes the after-hours earnings matrix, including the results for HPQ, CRM, MRVL, and ZS. The price reactions show a mixed picture for the market. For software, the bull case points to cheap valuation and high squeeze risk. The bear case highlights the Zscaler drop, no bottom in sight for INTU, and a rotation into hardware and memory. Our next section is a deep dive into Snowflake, specifically the $6 billion AWS deal, and what the balance sheet tells us, fact-checked directly from SEC filings. The headline after Snowflake's Q1 FY27 earnings was a 30% pop, driven by strong revenue and the $6 billion AWS commitment. This led to retail piling in, but we need to look closer at the balance sheet. Snowflake's revenue growth is legitimate, as shown in this chart. The question is, at what cost is this growth being achieved, and how long can it be sustained? The bull case for Snowflake includes strong product revenue, high net revenue retention, growth in large customers, and a 67% gross margin. AI demand is real, and customer expansion is legitimate. The $6 billion AWS commitment is a five-fold increase from the $1.2 billion at IPO. This significant commitment is tied to Graviton processors and AI chip infrastructure. Let's review Snowflake's cash position. While they hold $4.8 billion in cash and investments, their 5-year AWS commitment is $6 billion, which is 125% of their cash on hand. Snowflake has reported 3 consecutive years of GAAP net losses, with over $1 billion in losses each year. Over 3 years, $3.4 billion has been wiped out. The accumulated deficit for Snowflake is nearly $9.5 billion. These losses since inception are being paid for by shareholders through dilution. Stockholders' equity dropped from $3 billion to $1.92 billion in a single year, vaporizing 36% of the book value. This further illustrates the financial strain. Stock-based compensation, or SBC, is a hidden expense of $1.6 billion per year, which grew 290% in 5 years. Every dollar of stock paid to employees is dilution to shareholders. SBC, as a percentage of revenue, is dangerously high at 36%. Even the projected improvement for FY27 is still 3 times the S&P average of about 9%. Snowflake achieves its reported $1.13 billion free cash flow using an adjusted FCF calculation. This includes adding back $1.6 billion in stock-based compensation, masking the true economic cost. The gap between GAAP and non-GAAP FCF is $1.6 billion. Treating stock-based compensation as a real expense reveals that Snowflake has had negative economic FCF every year. Snowflake also has a $2.3 billion convertible debt bomb due in 2027 and 2029. When these notes convert, bondholders receive equity, leading to further dilution on top of SBC dilution. The Observe acquisition for approximately $600 million was mostly paid in stock. This acquisition added employees who receive SBC packages and created a 150 basis point headwind to FCF margin guidance. The buyback theater shows $150 million bought back in Q4 FY26 versus $1.6 billion in SBC issued in FY26. The buyback is barely absorbing 10% of the ongoing dilution. Shareholders are losing ground due to net dilution of roughly 6.4 million shares per year, based on the stock-based compensation and buyback figures. One genuine bull case metric is the net revenue retention of 126%. This means existing customers spend 26% more every year, which is a strong indicator of core customer satisfaction. Remaining performance obligations, or RPO, are at $9.21 billion, showing real customer commitment with a 38% year-over-year increase. The growth story has strong fundamentals here. The AI momentum is evident, with Snowflake Intelligence in nearly 2,500 accounts in just 3 months. They also added 46 new $1 million plus customers in Q1 alone, showing real demand. The Hollow Point verdict highlights what is real, like 34% product revenue growth and 126% net revenue retention, as well as what they are hiding, such as a $1.3 billion GAAP loss per year and a $9.49 billion accumulated deficit. Comparing Snow to other AI no-profit names, Snow has the largest accumulated deficit and the highest stock-based compensation percentage of its peer group. Institutions own it due to top-line growth over 30%, 126% net retention, and TAM expansion through AI. SBC dilution is seen as a future problem. The Snow pattern shows institutional accumulation between $115 and $145, smart money between $145 and $200, and retail FOMO at $240 to $305 post-AWS deal. Key moments to watch include the pre-market gap upholding, stop hunt back below $290 in the first 30 minutes, volume signals midday, MAC orders in the last hour, and SBC as a percentage of revenue questions during the earnings call Q&A. Section 5 discusses AI melt-up mechanics, focusing on $600 billion in share issuance, high complacency, and AI-driven wealth transfer. The Goldman Sachs Panic Index shows a 99th percentile complacency, with the lowest reading since December 2025. The market is currently unhedged. The expected share issuance for 2026 is a record $600 billion. This capital must come from money supply expansion or selling other stocks. The S&P 500 earnings forecast for 2026 anticipates 23% growth, doubling the 11.5% growth from 2024 to 2025. This is driven by AI-driven margin expansion. The AI wealth transfer mechanism identifies mega-cap corporations, AI-leveraged entrepreneurs, and capital owners as winners. Losers include call center and mid-skill cubicle workers, and anyone without AI augmentation. Long-term unemployment is rising outside of a recession, which indicates AI displacement in the job market. The Nasdaq 100 is experiencing a parabolic melt-up, smashing every monthly price target raised. This is characteristic of peak market euphoria. Asian markets, including SK Hynix and TSMC, are also parabolic, with SOXL up 4.5x year-to-date. The parabola is strongly present in the memory and chip sectors. Section 6 covers NBIS and the food chain, specifically Leupold's 5% buy-in, and why retail investors are the exit liquidity at this stage. Leupold's disclosed 5% position in Nebius Group caused a stock surge. However, Leupold is buying now at $213, raising the question of why he wasn't buying at $30, suggesting retail is the exit liquidity. The NBIS price journey has seen an 11x increase since $19. Citron called it at $19, and Goldman called it at $38. The question is, where are you getting in? Citron Research saw a massive return getting in at $19. Goldman Sachs saw a significant return starting at $38. The HPT community had a wide range of gains. Twitter retail is getting in today at $213 with an unknown potential return. Looking at the Avis case study, the social media peak marked the exit. The playbook involved the first wave of buyers, social media euphoria, peak euphoria, HPT selling and buying puts, and the subsequent stock collapse. The Meta subscription trade involved waiting after the news, noticing the lack of immediate movement, social media catching on, and riding the ramp out of the $28 day. Section 7 focuses on technical divergences. Key indicators like RSI, MACD, and AO across every time frame are signaling caution, suggesting the completion of Wave 5 of 5. A 5% intraday drop in SUX is a rare event. Since April, only 2 such drops occurred. The prior one led to more selling before a rally, indicating high significance. The S&P 500 shows a daily RSI divergence, price making higher highs while the RSI makes lower highs, a bearish signal. The MACD on the 60-minute chart exhibits a multi-point divergence. This suggests new highs are unconfirmed by momentum, which is a warning sign. The Awesome Oscillator shows a divergence larger than the one that preceded a nearly 10% sell-off, indicating a potentially larger correction ahead. The NDX is displaying a triple RSI divergence, another strong technical warning signal. Bitcoin correlation is turning positive again. Historically, S&P and NDX peak 2 to 6 weeks after Bitcoin tops, and we are currently in that window. Bitcoin's price structure suggests a 52% collapse pattern, following a similar playbook seen after its peak in October, which resulted in a significant drop. Section 8 examines VIX and market internals. The VIX is printing higher lows while the S&P prints higher highs, signaling a Dow theory sell signal. There is a massive discrepancy between VIX and S&P. S&P making new highs, while VIX does not make new lows, means the VIX has a higher low, which is a major warning. The VIX 50-day average is now above the 200-day average. This setup mirrors the 2007 market top and other major historical tops. The Dow theory sell signal is evident, as the Dow makes new highs, but transports do not. This non-confirmation is a classic sell signal. A VIX increase of 2.5% on an up day for the S&P 500, which was up 0.6%, is a major red flag. This suggests institutional distribution occurring beneath the surface. Section 9 focuses on crude oil and Iran, discussing a triangle pattern with a $119 target, despite current market pricing of a ceasefire. Crude oil is forming a triangle pattern, and an upward resolution above $119 is the projected move. The recent 7% drop was on ceasefire hopes. The market believes a peace deal with Iran is imminent, leading to lower oil and higher stocks. However, actual events, such as Iran laying new mines and U.S. strikes, suggest otherwise. The oil shock cascade begins with U.S. combat operations against Iran, leading to a crude oil spike above the $119 triangle target. This will drive 10-year yield surges and hot inflation numbers. The timeline suggests a July 4th deadline for market changes, driven by political pressure ahead of the midterms and historical precedent from the 2008 oil peak. Section 10 covers yields and inflation, noting the 10-year triangle ready for a breakout, the PCE report on Friday, and a potential Fed pivot trap. The 10-year yield is showing a massive triangle pattern that is poised for a breakout above 5%, potentially signaling the start of Wave 3 of Wave 5. The upcoming PCE report is expected with a headline of 3.8% and core of 3.3%. This inflation data could break the market's current complacency. The Fed's rate path is anticipated to shift from can't cut to will have to raise, leading to a market sell-off and eventual panic rate cuts that will be too late. Section 11 explores historical parallels, noting similar market setups in 2000, 2007, and Bitcoin's recent move, reminding us that past patterns often repeat. The 2000 market top saw a 17.5% rally disappear in just 3 days, coinciding with an inflation report. Everyone believed in a soft landing then too. In 2007, the market peaked shortly after a CPI rise, fueled by surging crude oil, leading to an immediate 20% drop and eventually a 50% total collapse. We see the same setup now. Hollow Point Trading reminds you that enrollment closes soon. The community is waiting. Find us on Discord, Patreon, WAP, Substack, YouTube, X, Instagram, and TikTok.